The conflicting messages in the media lately have left many investors wondering where our property markets are heading. Look, even different research organisations seem to be coming out with conflicting reports about what's happening in property markets. Hi, I'm Michael Yardney, and in today's update I want to look back at what previous cycles can teach us to see if we can make out what's ahead for homeowners and property investors. So if you're a property investor or keen to get involved in the property markets, this update is for you. Before I go on though, I'd like to quickly mention to you my new book, What Every Property Investor Needs to Know About Finance, Tax and the Law, written together with Rolf Schaefer, a top finance expert, Ed Chan, one of Australia's leading property tax experts, and Rob Belander, a property lawyer. We've put together the manual that you need to build your own property investment business. If you want to get the system working for you and not against you, click on the link below and get this great book, What Every Property Investor Needs to Know About Finance, Tax and the Law. Okay, back to what's at hand at the moment with what's happening to the markets. You see, recently there's been lots of concern about problems overseas, plus with our new budget, reports of further interest rate rises on the horizon. So no wonder so many investors are wondering what comes next. The problem is that many of these investors haven't owned a property through a complete property cycle, and this makes them uncomfortable as we move through the various stages of the property cycle. So today I thought I'd delve into my memory and see what I can remember, what we can learn from previous cycles to help understand where our markets are heading. Now, sure, we're currently in the slower stage of the property cycle. The bottom line, though, is that as a long-term investment, property is hard to beat. Look, I remember reading a research report from Massey University suggesting that Australian residential property has been the best performing asset class over the long haul. You know, this research dated back to 1920, that's 90 years, and showed that property produced on average a return of around 15% per annum. That combined capital growth and rental returns. And that was over that long time. Now, interestingly, these figures don't really reflect how good property is as an investment, because they don't take into account the power of leverage. And that sort of doesn't take into account the high return you get on your own funds, the money you put in. When you factor that in, property far outperforms all other asset classes over the long term. But don't get me wrong, while there's little doubt that property is a potent wealth builder in the long term, it goes through the same cycles as other investment classes, which means that those reported high long-term average returns take into account periods of high growth and also periods of low growth. You know, we have those every now and then, just like we do now, where property hasn't been going very far at all for a couple of years. You see, if I think way back, people who invested in Melbourne or Sydney in the property markets back in '89, there was a fantastic property boom, 87 to 89, they would have seen the value of their properties stagnate or even fall over the next 4 or 5 years. Let's go back in time further. Back in the 80s, house prices across most of our capital cities were stagnating for a couple of years. I know Melbourne's median price hung around $50,000 from 80 to 1983, and then it grew steadily and unspectacularly till 87, and boy did it boom then. Look, when I look back at Sydney statistics, the median house price was around $80,000 in 81 and stayed there for close to 4 years. Perth property prices were falling around that time, and Brisbane house prices were going nowhere for a year or two after 25% returns in the early 80s. And it took way until 87 until it all picked up. In Adelaide, there was a major rise in property prices in the 80s, between 82 and 84, and then growth slowed and grew steadily for around 5% until for most of the 90s. After crashing in 1990, property prices in Sydney and Melbourne stayed flat for quite some time and then steadily moved upwards. You know, Brisbane property prices were flat through most of the 1990s, and it wasn't until 2000 that prices in Brisbane took off after a decade of maybe only about 5% or less growth per year. And interestingly, this was despite a huge influx from other states to the Sunshine State. Followed the boom and bust of the late 80s and early 90s. And then the market ambled along with annual returns of about 6% until the middle of last decade, and then boy did the Perth market move when it actually almost caught up to Sydney. It had, I think, about 76% rise in 4 years. And just look at the last couple of years. Some of our markets performed strongly while others languished. Of course, Melbourne and Sydney were the shining stars in the last couple of years. Now, I've just rattled a lot of numbers and a lot of statistics, but the lesson to learn from all this is that property investors, you've got to be aware of these cycles. Now, sure, it's hard when you're in the middle of a flat period, just like Brisbane and Perth have been for a few years. But all you have to do is look back at what property prices were like 10 years ago, 20 years ago, and then look at property prices today. So property as a long-term play works really well. So you've got to be patient. You see, values in our capital cities have doubled every close to 10 years. So what were the factors behind these cycles? Partly it's the old story of supply and demand. Property prices are pushed up by demand created by a healthy economy, by high levels of employment, by population movements caused by migration and immigration, and in particular by positive market sentiment. When we feel good, when the economy is good, when we're comfortable with our salaries, our wages, our employment prospects, the market goes up. And they're dragged down when the economy performs poorly. That was easy to say. They go down when the economy performs poorly. Shouldn't have even tried it a second time, should I? When interest rates go up, when employment and immigration figures fall, when supply exceeds demand, and when the marketplace is nervous. So again, market sentiment makes a big difference. But you just got to accept that cycles are an inevitable part of any investment market. And you know what? Our property markets are behaving normally at present. One more thing. There are local as well as national property cycles. Each state is at a different stage of its property cycle. And within each state there's cycles in the various suburbs and cycles at the various price points as well. For example, luxury property is not performing well at the moment. Okay, lots of words. I guess you're wondering what's ahead. Well, eventually the cycle's going to move on. It always has, it will. And traditionally the more affluent suburbs tend to perform well at the beginning of the property cycle. And that's what's most likely going to happen again this time round. You see, eventually our economy and our share market is going to pick up. And the more affluent Australians are going to be back in the market upgrading their homes. And many of them are going to chase the same sorts of properties, pushing up values in our more upmarket suburbs. As values increase in these inner ring suburbs, the price differential between those suburbs and the surrounding, the nearby suburbs, is going to increase. The price difference is going to be so much that buyers are going to look for a bargain in these adjoining suburbs, and the high prices eventually ripple out to adjoining suburbs. This increase in property values and higher rents is also going to start attracting investors back into the market. However, many beginning investors, the inexperienced ones, are going to hold back at this early stage of the property cycle. They're going to wait for more signs of certainty. Of course, while they're waiting, many are going to miss out on those significant price growths that the savvy investors, those who get in early and those who buy counter-cyclically, are going to enjoy. Well, what about affordability? There's so much noise about affordability. Every cycle I hear the same cry. Property prices are too high, they can't keep going up. I remember way back in the early 80s, and I started investing in the 70s, people saying the prices are too high. Then in the late 80s, people said, look, house prices can't go up anymore. Our kids will never be able to afford a house. But prices doubled over the next decade, until again, they said the same thing in 2003. After that last boom, they said prices have gone up too much. Of course, many are saying the same thing again now. Now look, while most of us are sympathetic to the plight of the average first home buyer struggling to get into their first property, I feel that even though they don't admit it, secretly most homeowners and all property investors enjoy hearing how house prices keep rising. See, those already in the game take comfort in the fact that our homes, our castles, where we come home every night, quietly but consistently increases in value. And deep down, we hope this continues. Because not only does it make us feel wealthier, it actually does make us wealthier. There's no doubt that affordability is going to be an issue for many in the future. And this is going to limit the growth of properties, in the price of properties in some areas. more than others. For example, first home buyers and those in the lower socio-economic brackets are more likely to be affected by rising prices than those with more disposable income. What this means is that some areas, particularly new suburbs and the lower price suburbs, they're going to be underperforming. The upper, more affluent suburbs are going to outperform as the cycle moves on. So in summary, our property markets are behaving normally, the way they always have, and they're just working through their individual cycles. Within each state, the property markets are fragmented. Some suburbs are holding their own values really well, and in others they're slowing a little bit, but particularly I guess in the more outer suburbs, the mortgage belt suburbs, prices are languishing. These cycles mean there are great opportunities out there for home buyers and property investors who are selective and who think long term. Now, are you ready to exploit the opportunities that are going to arise? Now, of course, I'm going to keep you updated with how to take advantage of the changes that are happening in our property cycles in these fortnightly updates. But it's also probably appropriate to remind you that in changing times like we're experiencing, no one can help you quite like the independent property investment strategists at Metropole. Remember, our multi-award winning team at Metropole have no properties for sale, so their advice is independent, it's unbiased. If you want to find out a bit more about what's happening in your local markets and what our research suggests is in store for you, why don't you join us for a free briefing at our offices in Melbourne, Sydney and Brisbane? Just click on the link below and reserve your place. Now, there's so much happening in property nowadays, I'll keep you updated almost every day with a short post, not a long one like this, in my blog. So why don't you just click Michael's blog link up on the top there, in the top menu items on this page, and subscribe to it. Now, that's a different subscription to my regular newsletter. It gives you my short daily updates, and more people are asking for those, so please join us. Look forward to seeing you in your next update in a fortnight. In the meantime, have a great week. Make it a great week. This is Michael Yardney.